On today's show, we're going to talk about two of the most important building blocks of your retirement portfolio, understanding the role of stocks in retirement and why dividend growth investing can be such a powerful strategy as part of your retirement income plan. Welcome to another episode of the Simply Retirement Podcast, where we want to empower and educate women to live your retirement on your terms. I'm your host, Eric Blake, practicing retirement planner with over 25 years of experience, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. This is episode 3 of our 4-part series, 7 Essential Strategies to Successful Investing in Retirement. In episode 1, we laid the foundation by talking about the importance of having a plan that begins with your values, what's most important to you, and then identifies your financial resources. From there, it helps you answer the big questions. What do I need in retirement to live comfortably? And what do I want to do to make it meaningful? In episode 2, we talked about 2 of the most impactful strategies from a behavioral perspective by defining the true objective of a retirement portfolio, growth of income, not just trying to protect your principal. And we also discussed how to reframe how you think about risk in retirement, away from thinking in terms of percentages, such as percentages of my portfolio that I have in stocks or bonds, or percentages that my portfolio went down in a particular time period, to thinking more in terms of years of income, what I refer to as our war chest. How many years of income do you need in your war chest? Because this is key to protecting your income and your sanity during difficult markets. So please go back and check out those episodes. Today, we're going to move on and move forward to the key building blocks when constructing a retirement portfolio. So once we've determined how big your war chest should be, what's next? Joining me again on this episode is Wendy McConnell. Wendy, how are you?
I'm good. How are you?
I am doing very well. Doing very well. We got a little cooler weather. We're as we're recording this, we're at end of September, so it's no longer 105. So we're good.
Well, hopefully.
Right. We'll see how it goes. You never know, but yeah, we're all good.
Yeah, good, good. Glad to hear it.
Absolutely. Well, so are you ready to talk about the key building blocks of your retirement portfolio? Does that sound like fun?
Am I ever?
You just been waiting for this one, right?
Oh, I can't wait.
Well, so just as a reminder for all the links and resources, of course, go to the simplyretirementpodcast.com. And don't forget, please, if you have a question, you have a topic idea, a specific retirement challenge that you'd like to have covered in an upcoming episode, you can visit the simplyretirementpodcast.com/ask Eric. All right. So strategy 4, this is strategy 4 in our 7 strategies for successful investing in retirement. And this is understanding the role of stocks in retirement. Now, I completely understand that for many people, they hear the word stocks, it brings about the same feelings as pull the handle on a slot machine, like going to Vegas, right? You stick your money in and you hope for the best. And that's one of the biggest challenges for investors today is we just have this constant stream of news. We live in this 24/7 news cycle where every market drop like just makes the headlines. I always think it's so funny. CNBC is the worst at this, where you see the same people, the same individuals on the trading floor. They've got the big smiles, or they just look like somebody killed their dog or something. I'm like, how do they find the same guy? Do they just ask, hey, are you ready to take your picture for the day? I just don't understand. It's like crazy. But when we think about this, again, that's the issue really, is that the long-term history of the market tells a completely different story. Because the reality is, while all the daily noise can be really unsettling, the story over decades has been one of growth, income, and ultimately compounding. And that's really what we want to focus on today. So I've got just an example I want to walk through. So if we think about, we talked about in previous episodes, the last couple episodes being, potential retirement lasting maybe 30 years. So I'm going to just throw out a scenario here. Suppose you had $1 million back in January of 1993. And we said, okay, we're just going to put 75%, $750,000 into the S&P 500. So that's the stock part of our mix.
Okay.
We're just put the other 25% in fixed income bonds, safer stuff. Now, just to be clear, you can't actually invest directly in the S&P 500, but you can invest in mutual funds or ETFs that track that index. And we'll get a little bit more detail as to what the S&P 500 is in just a bit. But just so our example here. So also in this example, we're not taking withdrawals. So we're just kind of giving you an idea of just the long-term reality of what stocks have done historically over a 30-year time period. Because it's similar to what you might face actually in retirement. So let's talk about what happened. So first of all, the annual dividend income grew by nearly 5-fold. So 1993, you would have earned about $21,000 on that $750,000 deposit investment. So $21,000 per year. It increased to $115,000 a year by the end of 2022, just the dividends from your portfolio,
Wow.
right? And we'll talk about more about dividends just a little bit because that's also part of our conversation today. But again, increase 5x increase versus again in the previous episode we talked about if our idea is to grow income over time and inflation historically has been about 3%, that's a pretty significant difference. So again, the power of dividends in your portfolio. Now here's the other key, and this again we talk about the idea of growing your income over time, thinking about your principal. And again, because this is what most people worry about when you get in those retirement years. They worry about losing principal. They worry about their value going down. That $750,000 that we invested into our stocks grew to about $6.7 million.
Wow.
Right. And again, we're not taking money out, but again, just the idea of how this actually works. Again, what you hear in the news versus reality of what at least historically has happened.
Okay. So I used to hear, and correct me if I'm wrong, because this blows that out of the water. What I'm about to say is that traditionally it's doubles per decade what you have invested.
So there's the rule, something called the rule of 72. And so that's where that typically when people think about those types of things, and again, that's just a mathematical rule, not a real rule,
Right.
right? So but you think about, historically the market has returned between 9 to 10%. So if we're using that rule of 72, you divide that into 72, how long should it take for my money to double? Now, again, the reality is we know that that doesn't necessarily always happen the way it is. And because the other key thing about this 30-year time period that I just shared, so from 93 to 2022, it's important to note that this period included 4 bear markets,
Okay.
right? 2 of which were the second and third worst declines in US market history.
Yeah.
And this data that I'm talking about here, it stopped. I'm using 1993 through 2022. But if people remember, 2022 was right in the middle of that 4th bear market. So it doesn't even include the last couple of years where the market has basically just continued to increase over the last couple of years. That's 2.5 years, almost 3 years now. So this stops at the end of 2022, and still you see the power of what's happened. And here's another thing. Over the past 30 years, again, that's only 4 what we would call true bear markets. And a bear market, just so we define that, is defined as a 20% decline from the all-time high. So we've had 4 of those. Because if you watch the news, you'd think we'd have 4 every single year. So
You've had 4 of those ever?
4 in the last 30 years. 4 from
Okay.
1993 to 2022, we've seen 4 true, what we would call a bear market, a 20% decline from all-time highs.
Okay.
But again, if you look at the news, you say, well, we got at
Oh,
least have about
yeah.
4 of those, 4 or 5 of those every single year, right?
Yeah.
Especially when you look at those guys with the sour face and look on their faces on CNBC.
Yeah, the only time I was very, very concerned was during COVID when they actually shut them. I think 2 days they shut the market down.
And that is actually one of those 4. So when you think about the 4 that we've experienced, so we've got 1990 Y2K, 9/11, we have that window of time there. We've got 2008, which is the financial crisis. So those were 2 when I talked about these 2 of the worst that we've ever had. That's the 2. Y2K, 9/11, financial crisis, pandemic, and then 2022. So those are the 4 that we're talking about here. Now, here's the other thing again, because people, again, so often they think about this just like it's gambling. But here's the reality of the situation. And we're going to share a lot of these links so you can actually check this up for yourself. If we just took just look at all historically the rolling 30-year periods going back all the way to 1926, which is kind of where the S&P, the quote unquote S&P 500 started. The worst rate of return, the worst average rate of return over any 30-year period was September 1929 to September 1959, 7.8% average annual return. So over any 30-year period, just pick a 30-year period in time and say, what's the worst I might have experienced?
Okay.
It's an average return of 7.8% a year.
That was the time between 29 and
That
59.
was the time period from 1929 to 1959.
It still gave out 7%
7.8% per year average rate of return, even during that time period.
per year.
Right?
Okay, great. Yeah,
Average. That's the per year average, right? So
I'll
again,
take it.
that's where we talk about where the gambling component or where the mindset comes in terms of thinking about just putting money in a slot machine. If you just look at one day, which is unfortunately is how a lot of the news reports it, yes, it's about a 50-50 chance of money you're going to be up or down in one single day. But the longer we go in time, the less risk you actually have,
Okay.
right? So and then we look at a 30-year period, the worst 30-year period, just carving them up, just look at any 30-year period you want to pick out. Going back to 1926, the worst 30-year return, average rate of return per year was 7.8%.
Did you sit down and figure all this out, or is it like in a study or something? I want to see how nerdy you really are.
Now I'm pretty nerdy, yeah. It's not so I know the information, but unfortunately, I also have to, for compliance reasons, I have to make sure I prove my nerdiness.
Did
That's why I said we're going to share these links, so we're actually going to have some of these links to articles and research that people can actually go just so they can see for themselves.
I can see you just saying, "Well, let's figure this out."
No, 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 no. No, I'm not that nerdy. I know it's there, and again, we have these conversations with clients all the time,
Okay.
and so having the resources and having access to information, and I'm not really, that's one of the things. I just so people don't think this is what I'm talking about is percentages and dollar figures and S&P 500. That's not all the client conversations we have. But when you're preparing for retirement and you think about, as scary as all these bear markets are, and then when you're going through them, it's not fun at all. And that's really because the emphasis is placed on these events when you talk about news and social media. And the reality is, it's a clear case where almost every time doing nothing is almost always better than doing something,
Okay.
right? Because in most cases, when people are in the middle of these bear markets and they're worried, they're scared, doing something is almost always some emotional reaction out of fear, or maybe even it could be even completely irrational. Then people will do things they know is not the right thing to do, but they still do it because of the fear of, well, what if this is the first time in history the market really does decline permanently? Because that's always one of the things I talk about. There's never been a permanent decline in the market. It's always temporary. And it is, and again, our compliance folks they'll force me to say, nothing's guaranteed.
I know.
Nothing's guaranteed, but at least historically, there's never been a permanent decline.
Right. Absolutely. Okay, I got you.
And ultimately, again, as we talked about with strategy too, if the primary goal of our retirement portfolio is to provide growing income that hopefully meets or exceeds inflation, hopefully actually growing our principal as well, if that's even possible, then we think about, okay, a portfolio consisting of stocks and dividend paying stocks, which we're going to touch on next. If we have our buffer of low risk stuff, our war chest in place, maybe around 5 years of income, this is one way, maybe the best way that we can actually accomplish that goal of growing our income over time, providing the resources we need, but doing so over what could be a 30-year time period where we know prices are going to continue going up.
Okay. So this is based on the fact that we may have a 30-year retirement.
Absolutely. Because the odds are, thinking about, again, we talked about this in the past episode. If a couple is retiring together at 62, non-smoking couple, there's a 50-50 chance that at least one of them is going to live to 92 or longer. So that's where we have to think about, what is our retirement strategy going to look like if prices are going to, and we could use your rule of 72. Now that means that every 20 years, our cost of living is going to double
Okay.
using a 3% inflation rate.
Okay.
Rule of 72, 3%, about every 20 years-ish, the cost of what we're spending money on is going to double. And so that's where historically, again, stocks have provided the best hedge against inflation, or again, I hate to use the word inflation because again, it's more, if you think about the reality of people, it's purchasing power. How can I continue to live the same lifestyle I have today, 5 years from now, 20 years from now, 30 years from now? And again, historically, stocks have provided the best way of making that happen.
Gotcha.
Okay, so now we talked about the role of stocks. Now we want to talk about, and this is strategy 5, the value of dividend growth investing as part of our stock strategy. So first, I want to just give you just a simple definition of what a dividend actually is. So when you buy a stock, whether you're buying it in a brokerage account or you're a company stock purchase plan, your 401k, wherever it might be, you become an owner of that company.
Okay.
And I think that's one of the things I'd really like people to take from this is, when you just look at your statement, if you've got a 401k, you've got an IRA, you just look at your statement. So many people just look at the value and did it go up or did it go down? But I think one of the ways people can really take ownership of this is thinking that if I buy that stock or I buy that stock fund, the stuff in there, I am actually an owner of that company. I'm an owner. My example here, I've got Apple. So if you buy Apple stock, even if it's only a single share, you are now an owner of Apple.
I want Apple stock.
Apple stock has been pretty good. Yeah.
I want to say I own part of this company.
I would go back and buy Apple stock like 30 years ago.
Oh, I know.
But when you think about it, then so when Apple makes money, and any stock, if you own a stock and it happens to, we'll use app, keep with our Apple example, they may pay you a dividend because if Apple is profitable, they pass that profit on to their shareholders. Which, if you again you own one single share, you get to participate in that. So many companies that pay dividends, they pay those dividends to their shareholders. That means that's another way of making money on your portfolio.
Okay, but that stays in the portfolio. It's not like you're getting a cash out.
It depends.
Oh,
It can't. You can't. So if they are paying, so again, the stock itself. So if Apple pays a dividend, they're just paying it out. Now you have the choice of, do I reinvest that dividend and buy more shares, which actually we're going to touch on in just a bit,
okay.
or do I take it as cash? You have them send you a check. Either way, that is your small piece of Apple's profits.
Okay.
So if you think about that again, when bear the market going down, bear markets are never fun. But if you put in perspective and think, okay, if I own S&P 500 index fund, I'm going to have Apple in there. I'm going to have Nvidia, which is the hot one the last couple of years. You can have all these different Amazon. The S&P 500, that is thinking about this, that's the largest 500 companies in our economy.
Mm-hmm.
So if I buy an S&P 500 index fund, I own all those. I own a small piece of those.
Mm-hmm.
So if you think about owning those, and you think about our economy and the companies that were in that mix, how many of those are likely to go to zero?
Well,
Right.
not all of them.
Right.
That would be the hope.
And that's diversification. But that's also the idea of saying, okay, if we see a decline in the market tomorrow, but I own Nvidia and I own Amazon and I own some of these companies, if I can say, okay, in my mind, if I can focus on that versus just thinking, okay, I'm hearing on the news that the market's down. Well, if I'm an owner of these really solid companies, these great companies that have technological advances or medical advances or whatever this company might do, hopefully that puts a little bit more perspective around, okay, this company is still a good company.
Mm-hmm.
Just because the market's down doesn't mean this is all of a sudden this is a bad company now. So if you can keep that mindset, I think it goes a long way to, again, maintaining your sanity when everybody on the news is telling you to sell or buy or do something. Like I said,
Yeah.
the news is always telling you to do something, which almost every case doing nothing is actually probably the better way to go.
And now that I know that I own part of Amazon, I can call customer service and be like, why is my package late?
They'll push you right to the front of the line. Yeah, they'll push you right to the front of the list.
Yeah, I want my package now.
Apparently we don't have any problem with Amazon packages arriving. We get one at least 2 a day, I think. So I don't have any complaints. My complaint is not with Amazon. My complaint is the initiator of the request,
Oh, okay. Gotcha.
which I'm a big part of that. So I can't, I'm not definitely not passing blame there.
Yeah. Okay.
But so now let's talk about the dividend piece of this. So again, we've defined what a dividend is. So a company is profitable. They pass those profits to the shareholders, which is you. If you own a share, one share, you're an owner. But here's really where the power lies in this. So if we go back to 1960, we talked about a couple of times where inflation has risen by about 3% a year. But over this same time period, we go back to 1960 through 2022, just sticking with that time period, the dividend has grown. The dividends of the S&P 500 has grown about 5.8%, almost twice the rate of inflation.
Okay.
So these companies, the more profitable they are and they maintain that profit level, if they're continue to be profitable over time, they should be increasing those dividends. And that's exactly what's happened. Again, I'm talking specifically about the companies in the S&P 500. So those companies could change. There's going to be different companies in 1960 than there are in 2022 or even today. But just saying, okay, if we invested in the S&P 500, the dividend has grown at by 5.8% a year since 1960 versus a 3% increase in prices or inflation.
Okay, I'm not a numbers girl, so I'm trying to wrap my head around this. So is this 5.8, these dividends, is that on top of the value that the
Yes,
stocks are increasing?
absolutely. And I think that's where I'm going with this is when most people think about stocks, they buy stocks, again, because this is what you hear on the news, all you're thinking about are the ups and downs. But if you're buying a stock and you have a diversified portfolio, that is just one component of your earnings in that portfolio. You have the appreciation, so the increase in the stock prices, But a big component of your return on your portfolio is that dividend income that has historically, since 1960, increased by 5.8% a year. So there's the two components of growth or earnings. And this, again, this is why stocks have historically been such a great way to grow income over time, is because you have these two pieces. So that 5.8% increase in dividends doesn't even include the appreciation, the increase in value of those shares. Does that make more sense?
I like that.
Absolutely. And so again, this is why all these pieces fit together. And again, these are just the best stocks. So we're talking about the entire S&P 500. So, and we're talking about that again, just as a quick definition, the S&P 500 being the largest 500 companies in our country, most of which you've probably heard of. We've thrown a couple of names out there, but these are the big guys. And these are in many cases companies you have heard of. They're not the little small caps or the mid caps, which doesn't mean you shouldn't have those in a diversified portfolio. But we're talking about in our example here, in the power of compounding, the power of dividends. That's where we're using the S&P 500 as our key index here, our key investment component at this point.
And that's a large cap.
That would be considered large, yeah, because they're the largest companies out there. They're the top 500 companies in our economy.
Does large cap mean the same thing as the S&P? Are they interchangeable or are they still different?
So the S&P 500 specifically is the largest 500, but then you have others that might not be quite at that level, but then you're going to have growth company, you're going to have large company growth, large company value. So large cap is referring to a large company, that capitalization
Okay.
of a particular company being above a certain level.
Okay.
So you have, for example, you have large caps or large companies, you have mid caps or mid-sized companies, small caps or smaller companies. So again, we're talking diversification. You might have some of all that, but specifically around large cap or S&P 500, those are the largest 500 companies in our economy. And again, if those are the largest 500, they've done something good to get there, right?
Yeah.
So they've been profitable and they're passing those profits down to their shareholders, which is you. If you own the S&P 500 index fund, you're receiving some part of those profits as a dividend, plus the appreciation. So in our original example, we talked about if I had took that $750,000 of my million and I invested in the S&P 500, my dividends went up 5 times. Just the dividend income increased by 5 times. And my appreciation went from $750,000 to $6.7 million. So there's both pieces of that puzzle.
Yeah. Okay.
So we talked about dividend growth investing. Again, the other thing that dividends help with, and I think you kind of touched on it, but I want to just come back and just walk through this, is dividend growth investing can also help you reduce some of that stress of, okay, if I need income, I got to figure out what to sell. Well, if I'm getting dividend income, I might just choose to have them send me that as a check or a direct deposit into my bank account. So that might allow me to, again, take income without actually having to sell anything, without having to
Yearly?
sell shares. Yeah.
So once a year we get dividend income.
Well, in many cases, stocks will pay quarterly dividends. Again, depends on the stock. So again, that's where you kind of get into, okay, in most cases, stock funds or stocks will pay quarterly dividends.
Okay.
You might have bond funds as well, which is a whole nother category where they might pay monthly. But you want to understand what you own and why, and what is the dividend schedule. But if I'm getting a certain amount of dividends every quarter or every year, depending on how I set it up, that allows you to say I'm getting income without having to sell anything. Maybe I don't have to sell anything at all this year. So it just helps you control your investment strategy and control your income. And again, the other thing that's interesting is dividend growth companies that have historically grown their dividend over time. Historically, they've also been less volatile than non-dividend paying stocks.
Right.
Ideally, you get the best of both worlds. You get ongoing value, ongoing income with less ups and downs, less of a roller coaster ride, we'll call it.
Okay.
Right. And then when you reinvest those dividends, maybe you say, okay, I don't really necessarily need the income, or I want to reinvest those. Now we're talking about buying more shares of whatever that fund is or whatever that stock is. And that's what you touched on earlier, is you have the option, okay, I can take the income, the dividends as cash or as check, or I can reinvest and buy more shares. And that's really where that compounding comes in.
Okay. So the benefit of reinvesting it is the compound factor.
Exactly. Because you're just buying more shares. And over time, if those shares increase in value,
yeah,
you can see how quickly that can compound not only your portfolio, but ultimately your income.
Okay. And then there's something, you could change that up just in case of an emergency.
Absolutely. Yeah. And then that's where you have the war chest. So that when we talk about putting all these pieces together, we start looking at our war chest, which we talked about in our last episode. How many years of income do I want to help protect me against volatile markets? Because they're going to happen. It's not a matter of if we see a down market, it's just when. And
Hmm.
what do we do to set up our portfolio to protect ourselves, to protect our income? That's what the war chest is. So maybe I have 5 years of income. So we used that example in the last episode talking about the financial crisis, where it took about 5.5 years to go where we were at the very top in 2007 back to break even. It took about 5.5 years. So if I have a 5-year war chest, we'll call it, then on top of that, now I add my other two building blocks, my stock portfolio, plus some component of that with dividends, having dividend paying stocks. It all fits together to again provide the income that you're looking for again over what could be a 30-year retirement.
Okay.
All that makes sense?
You know what? You're making me a happy girl. I'm loving all I'm hearing.
But so with your war chest protecting your short-term needs, your stocks, including your dividend-paying stocks, working for the long term. Actually, we just want a strategy that's built to last over a 30-year retirement, and that's what these last couple episodes have been about. Next episode, we're gonna get into a little bit more of the nuts and bolts of taxes and strategy 6, which is managing your portfolio tax burden in retirement. But they're also gonna help you answer the question: should I work with an advisor, someone that can help tie all this together into a confident, effective plan? As always, thank you for tuning in. Big thank you to Wendy for chiming in and helping me narrow this down and hopefully share some value that people can utilize in their own retirement situation. If you have questions about investing in retirement, you can also email me directly at eric@blakewealthmanagement.com. I will read and respond to every email personally. But if you're looking for a personalized retirement plan that helps you make smart decisions around income, investments, and taxes, visit getmysimplyretirementroadmap.com to schedule a call with our team. That is it for today's episode. As a reminder, for all the links and resources mentioned today, visit the simplyretirementpodcast.com. As I said, we're also going to be sharing links to some of this data and historical information that you can review for yourself. Don't forget to like, follow, and share our show. Until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road, it is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.